Joining us for got a little head start there. Welcome everybody to our huddle today. We put together these huddles as a way to give our investors, apartment investors, and those interested in apartment investing a way to stay on top of the topics that are near and dear to all of our hearts. And today we have a great topic. Everyone's heard about the one big beautiful bill. Regardless of which side of the aisle you sit on, I think there are opportunities here with the tax savings to really benefit multifamily investors. And so that's what we're here to do today. I will start by saying that I have with me Victoria Garza-Fraser.
Hello.
And she works managing all the cost segregation studies that we do for all of our acquisitions. And then on the year after that we complete renovations, we will do a secondary cost segregation study to capture any of the new assets, improvements, et cetera, that we've placed into service. And so, and even more exciting is we have Brian Bigham with us today with Madison, and they have done our cost segregation study. So he's very familiar with REEP, and he's very familiar with cost segregation studies, which is a big piece of how we as investors have a great opportunity to save on taxes, whether that's today or we carry forward those losses into the future to save when we end up selling a property. But I realized that I didn't properly introduce myself. I'm Arleen Garza, founder of REEP Equity. We have been in the multifamily space since 2012 when we bought our first 24-unit property. And to date, our team, which Victoria leads our acquisitions, has been involved in 34 transactions, over 750 million in assets that we have bought, managed, or sold. And we continuously are looking for opportunities. And today the opportunity is saving on taxes. So over the last 5 years, we've saved investors, or shared, let me put it that way, with investors, over $75 million in tax saving opportunities. So we're always looking for every opportunity we can. And I like to call it the icing on the cake. You get to buy this great property, and we get to make it great community, improve the community so residents have a much nicer place to live, and we get tax benefits from it. So, in the last years, that bonus depreciation percentage declined. So this year we were sitting at 40% had the one big beautiful bill not passed. So I won't steal Brian's thunder in sharing more about that. And then Victoria will be sharing some other questions we have along the way. But I want to encourage you to submit your questions in the chat. And as we have time, we will get to those. And just to say that neither Victoria nor I, neither Brian, are tax professionals. So we're happy to share what we know, but we are not providing tax advice today. So for that, we highly recommend you speak to your tax professional. So with that, let's get started. Brian, I'd like for you to introduce yourself. I won't do it justice because you've been doing such good work for us. Share with us about your background and what you're doing today.
Yeah, absolutely. Thanks for having me on. I really appreciate it. It's one of the things I love doing more than anything is just educating people, because you never know, like, everybody's got a different tax situation, everybody's got a different investment portfolio, but ultimately the name of the game is to fight the taxes legally. Let me put that out there. But so I'm, again, Brian Bigham, they call me the cost seg cowboy. Maybe it's because I'm from Texas. Maybe it's because I enjoy doing cost seg on ranches a lot, so it's kind of whatever. But, I've never ridden a horse. I do own a cowboy hat. Who knows why they call me that? But
I did not know that about you. Wow,
really,
that's awesome.
That's a
Yeah.
oh
cool
yeah,
nickname. Yeah, I love it.
yeah.
Yeah.
Somebody said it on stage about 2 years ago when they were introducing me, and it just kind of stuck, and now it's kind of a brand.
Love it.
Which, no pun intended, a brand, cost head cowboy. But
Awesome.
but regardless, I've been in real estate for almost 20 years in some form or fashion. Usually everything back of house, from brokerage, management, leasing, subleasing, to I've been doing, the tax side of commercial real estate for almost 8 years now straight. And it's just been a whirlwind of awesomeness, honestly. Because one thing you always want to know about investing in a property is how much in the returns you're going to get, how much income, how much money you're going to make. But nobody was thinking about it, 5 or 10 years ago, about how much they're going to owe in taxes at the back end. So now, when I got into this realm, the tax realm, it just became a, why isn't everybody doing this? Why doesn't everybody know the details? Even CPAs and accountants, a lot of people miss over the massive tax benefits that real estate bring. So I jumped in it and been doing it ever since, and I love it. So
Yeah, that's phenomenal. Yeah, it is a big benefit. And when we first started, we didn't know about it, like you said, and as we started talking to other owners, we learned about that opportunity, and we immediately started with the cost segregation studies and making sure that we maximized the tax advantages for our investors. So
absolutely, and that is
yeah,
you're right, the icing on the cake.
yeah, yep. Well,
For
with
sure.
further ado, Brian, would you like to run us through some of the summary slides you have for us today?
Oh yeah, yeah. Let me share my screen. You just tell me if you can see it.
We can,
Got it.
yes.
Okay, perfect. All right, so really this is, I've been doing presentations regarding cost seg and bonus depreciation for the last 6 years. And this year, of course, since July 4th, the one big beautiful bill came into play. And this is something I'm always like touching on, and forgive me, I like to ramble on about a lot of things, so just keep me on track if you want. But
Okay.
one thing that I have found, I listen to economists all the time about the market fluctuations going up and down, lender rates, mortgage rates, everything across the board. One thing that I saw that a few accountants and I were speaking about was the correlation between bonus depreciation and the real estate market, more specifically multifamily. And I don't know if you actually put them side by side, around 2022, the market was just going straight up. Everybody was buying, everybody was selling. Like, interest rates were down, lending was just left over and right, handed over to everybody. And then as soon as that was the last year of 100% bonus depreciation. Now 2023 went down 20%. The market kind of leveled out a little bit. It plateaued. 2024, it started to decline when bonus depreciation went down another 20%. And then in 2025, it started going straight down until this bill was passed. All of a sudden, the market, it went straight line again. It plateaued. So now we're going to be looking at a trend going straight up. 100% bonus depreciation is going with the market. So that was just something that I noticed you said earlier, and I always wanted to point that out. So, okay, one big beautiful bill. So let me make sure I can. There we go. Okay. So essentially, the one big beautiful bill was to put in tax breaks specifically for real estate, amongst other things that go into real estate. And these are things like, the Medicare acts and bonus depreciation, opportunity zones, opportunity funds. There's so many different little details that were added to it. It's just a matter of breaking down what benefits real estate investors the most. So today, because I do bonus depreciation and cost segregation, I've got a handle on that. Let's talk about that. So essentially, it benefits every investor when it comes to real estate. fund managers, high net worth families, everybody gets a little extra piece of depreciation or losses based on their investment into a property. So bonus depreciation became the cost thing on steroids. It essentially allowed every investor that put their capital into a deal to take the largest percentage based on their ownership percentage in losses the first year. And this goes anything from, if you have a deal that you place in service in March of this year, you get March through December. If there's a deal that closes December 31st of this year, in 2025, you get to see that 100% bonus depreciation losses for 2025 taxes that you file 3 months later. The bonus depreciation just becomes a monumental tool for, real estate investors to offset all of their passive income from that investment.
So any asset placed in service as of January 1 of 2025, is that the date?
It's actually the 19th. And actually, I do have a slide on that.
Okay,
Let me
perfect.
see. I might be able to get to it faster. Yeah.
Okay.
So,
Awesome.
and I can send, if anybody, wants to have this, I have this presentation is like 30 pages long because it also includes, other than bonus depreciation, it includes opportunity zones, 1031, all the changes like summarized. The one thing, when I got in this business, the one thing I did not want to do was be the guy that everybody falls asleep to while listening. So I promise you, I have summarized it, and it's going to be beneficial for real estate investors specifically.
Great. Awesome.
But yeah, just ask for it. I've got it on a PDF. I can send it to any email. But really, the January 19th, 2025, that's the date. That's your placed in service, or the new magic date that they call it. But there are a couple of exceptions. So if the property was placed into service January 19, 2025, or closed on and placed into service, the one caveat is, if you guys got a deal under contract, let's say January 1st of 2025, you got it written under contract, it is date stamped, and then you close and place it in the service later on, like let's say March 2025, technically you cannot take 100% bonus because it was before the magic date, the January 19, 2025. And that also goes in place with construction. If you had a new development that was coming online and you decided to wait, put it off and do it when 100% bonus was eligible, technically when it was being constructed, that's the date you have to use to get the 100% bonus.
Great.
So there are some caveats.
Mm-hmm.
Yes. And let me be very, very clear, because this is actually a question I've had a lot recently. If you are doing 2024 taxes and you want to take advantage of the 100% bonus, if you place the property in the service in 2024, doing your taxes now past this date, it doesn't count.
Okay.
Be very clear. I know that's weird, but believe it or not, the dates, the timelines, everything matters when it comes to the IRS. So you got to be very specific on the key dates. I can walk anybody through like kind of little tidbits, loopholes, whatever you need to actually get it to that 100% point. But every property is different.
Okay. Thank you for that clarification.
Oh yeah, absolutely. I don't know if I need to go back any, but if anybody is not familiar with bonus depreciation, essentially when you buy a commercial real estate property, you've got 3 options available to you when it comes to depreciation in general. The first one is straight line depreciation, and that's what 60 or 70% of the commercial real estate owners out there are doing, not because they should, but because they don't know any better.
Yeah.
So it's basically taking that basis, that your purchase price minus the land, that's called your depreciable basis, and dividing it by 27.5. That's how much you're getting every year. That's called straight line depreciation. The next step above that is cost segregation. And that's essentially taking the same, assets that are on the property, and instead of dividing by 27.5, you're pulling each asset and putting it into its life expectancy, or otherwise known as 5-year property, which is tangible assets, 15-year property, which is exterior land improvements or land improvements. Actually, that's been renamed. And then the rest of it is 27 and a half year, which is structural, making the property habitable. So by doing that, you are 2 to 3xing the amount of depreciation year 1, 2, 3, 4, 5, 6, and so on. But it's still spreading it out for you. And then, of course, the next step up is 100% bonus. This gets you 10x the amount of losses the first year that the property's in service. Doesn't matter what the date is, you get all of it. 5, 15, and that 27 and a half year prorated amount. Oh, I was quick, but hopefully everybody gets it. If not,
So-
I'm happy to explain it more.
Okay, so you said you'd get the 5-year, 15-year, and some of the 27 and a half?
That's correct.
Okay,
And the reason why only a portion of the 27 and a half is because the bonus depreciation rules from previous years still apply. Bonus depreciation is only eligible for anything under a 20-year life.
okay,
So that's all that 5-year, 15-year, 7-year. There's even 3-year, believe it or not. But the only ones that really make a difference for multifamily is usually 5 and 15-year.
okay,
But the 27 and a half year or the structural components, because it's over 20-year life, it stays the same years 1 through 28, which is not a bad thing. That's perfectly fine, because that basically is telling you that no matter what, you get depreciation every single year during ownership.
Yeah.
Yep. So with that being, it just comes back to, how is this 100% bonus depreciation? Why was it such a big deal when it was, rephased or like repassed on July 4th? Well, it helps just about everybody involving real estate. Active investors, short-term rental operators, passive investors. I mean, you guys that put your money in this, I'm speaking from experience myself as a passive investor. It is fantastic seeing all those losses on your tax returns. Fantastic. So it essentially it becomes, how can you utilize it in your tax strategy? And that's where, all your CPAs, your tax prep people, your tax preparers, anybody that deals with taxes in general for you, you need to make sure that this is applied correctly and applied beneficially. So really, again, I already told you about the bonus depreciation changes. I mean, it was 100% was reinstated. 2025, it was at 40%. Now it's at 100%. And it is a big deal, guys. So I already went over all this. See, I'm jumping around too much, but I want to answer questions.
so how long I know before there was, we had 100% and then it changed annually. So how long is the 100% available for? Until what year?
Until 2029.
Okay.
So it almost went right back to what it was back in 2017. So it was from 2017, the end of 2017, which was October of 2017, until the end of December 2022. Sorry, my dates. I had to make sure I got my dates right. So the December 31st, 2022, that's when 100% originally stopped. And then all of 2023 was 80%. All of 2024 was 60, and then 2025 started at 40. And I guess they got wise on Capitol Hill and decided to restart it. And now all of a sudden, there's just deals are starting to fly left and right for everybody.
Sure. Well, a lot of the leadership in our country owns real estate, so
That is correct.
yeah.
And hint. Why do you think 1031 hasn't been changed? It's been talked about, but hasn't been changed. I wonder.
Yeah.
But yeah. So, but going back to just in any deal, any individual deal, any syndication deal, whatever, every passive investor gets to benefit from it, especially now with the new bill and everything put out, because One thing that this new bill did touch on was the exit strategies. So when you exit a property, everybody's always talking about the gains, the recapture, the basis, everything like that. Well, now they've put in a couple new pieces, more specifically with 1031 and opportunity zones and group funding and everything like that. That now you have a much greater chance of keeping money in your pocket upon exiting a deal. Greatness. But yeah, I mean, passive investor, if you invest your capital into one of REEP's deals for very specifically, you would be able to offset a ton of things. Not just don't just focus on W-2, 1099, anything like that. I'll explain that in just a second. But just putting your capital in, you're going to be able to offset the income that you're getting from that property, from other properties, from some private funds. And you can also, if let's say this is not your first passive investment, you have another passive investment that's about to go full cycle, you can use these losses to offset the entire gains from the sale of that property, the other property. So it's a big strategy play, but if you know all of that you're getting from each investment, you'd be able to sort of like combine them and utilize them on the back end. And that's something the IRS wants people to do, but nobody wants to talk about it. So this is what I was talking about earlier. You, as a passive investor, you would be able to offset quite a bit, but there are things you cannot offset unless you meet certain qualifications. So for instance, you cannot use the losses that you're going to generate from your investment with REEP to offset W-2 income or active business income. If you have an interest or a dividend from an investment or a fund or something like that, you cannot offset it with that. Capital gains from stock or crypto, you cannot, because it's a different classification of capital gains. So even as a passive investor, think of investing in real estate, investing in a syndication as a way of parking your money in a newfangled tax shelter. So you would be able to park your money in this deal. It will generate income for you. You will get a massive amount of losses that will sit in your tax returns 2025, 26, 27, 20, however long you have them. They're going to sit there and just offset the gains every single year from your investment. And when you go to sell the property, it used to be that you would have to pay a percentage on the gains and the recapture, but now you have the ability to move things out and move them around to actually lower your gains or completely defer it or push it out until you die. Kind of morbid, but there's so many different ways they're giving you now to invest in real estate. It's nice having a real estate person in the Oval Office again. But yeah, so it's okay. So if anybody has ever heard of the passive versus active real estate investors, that's kind of what I've got on the screen. That's what I've been touching at. So the passive investor is essentially somebody that's maybe they work another position, a high net worth position, and they're putting their money into real estate so they can get the additional returns or offset their portfolio with different things, not just stocks, but maybe also real estate. But this right here, the real estate professional, that's the gold standard when it comes to real estate investment and offsetting with all the losses. So as a real estate professional, you guys would be able to not only offset all the passive income from the property you invested in, but you can also offset now W-2, 1099, stock, crypto. If you had a garage sale and actually told the IRS how much you made, you can offset it with these losses.
Wow.
So this is the gold standard, the real estate professional or rep. The idea of getting this is the exact same. That was not changed by the bill. But in order to become an active real estate professional, you would need to get 750 hours or more of involving real estate. And that's whether it's transactions, closing, trading, management, maintenance. I mean, you name it. If you actively put into 750 hours a year, a calendar year, that's qualification number one. The second one, which is an and, it's not an or. It's not a 750 hours or. This is a 750 hours and 50% or more of your business is involving real estate. And don't let that think that that's a broker. You don't have to be a broker to enjoy this. No, if you own an LLC, run an LLC, or run a fund or a capital group, or you visit properties, maybe you're a surveyor, maybe you're an appraiser, and you visit properties every day, that technically qualifies you for both 50% of your business and the 750 hours. It's just a matter of making sure that you meet these qualifications, allow you to offset everything that you have to pay taxes on, everything. So it's a nice little benefit. And the air is better up here, guys, when it comes to active real estate professionals.
Yes.
You would never know how you could have a rainy day fund of just losses. It's a great, always a great problem to have.
It is. As I said earlier, we've, been able to share 75 million in tax benefits with our investors. So that's been wonderful. And I love the fact that, Jacob and I are carrying forward losses because they can be carried forward indefinitely unless the bill changed. But I know we can carry forward those losses indefinitely. So that's also nice.
Absolutely. And you're 100% right. That didn't touch, the law didn't touch that. The bill didn't touch anything about carrying forward. I mean, you're good. You're good. And you can carry them forward. You can utilize them for multiple properties, not just one, but multiple properties on sales, on you name it. And, what she was saying earlier was the concept of sharing it with your investors. And that's one thing I always want to touch on as well. When it comes to a syndication or a multifamily investment or any kind of investment that you have investors putting money in, every investment capital from a passive investor is you're buying an ownership percentage of the entity that's buying the property. Now from that's where all of your losses, your income, everything is based off of that ownership percentage. And that's how you're able to share these losses across the board, and how GPs, extremely great and ethical GPs like yourselves, they get so many great investors that want to keep coming back because they are treated not only with the high income level that you guys have on every property I've seen, but also the max losses to offset that one, the next one, the past one, the future, everything.
Yes.
So the sharing of that is for your investors. They are just sitting pretty every day, every year. So it's very good. But what else? I mean, a lot of this is different, but short-term rentals, the same concept that hasn't changed. It's called the short-term rental loophole. But essentially, if you're investing in a short-term rental as a passive investor, technically, if you actively participate in managing it, it falls under a certain section 469 that allows you to use all of the losses to offset any active income. That's regardless if you're a passive investor or active real estate professional. You can use all the losses in a short-term rental to offset anything you want. W-2, W-9, 1099, charitable, whatever. You can offset everything.
Great.
Yep. But again, you and your CPA or your tax preparer need to know the details and have like hour sheets or whatever, but you can literally utilize it to offset anything.
And I know, Brian, that there's some apps out there that help you track not only the hours, but some of these other items. I'm not familiar with any particular one, but I've seen some chatter on some, groups that are asking for that. So just be aware there are apps out there. I'm not sure of any, but there are some.
I use one for a lot of my single family rentals, and it's called Toggle, Toggl.
Okay, great.
that's something to just, you click on it and go. But I did find one issue. You have to make sure and click it off when you're done.
Okay.
I was like, how did I work like 2,000 hours last year? It didn't make any sense. So I forgot to turn it off. It's working in my sleep. Okay. Grouping elections. This is something I kind of touched on earlier. It's extremely complicated. This is one of those where if I did talk about it, I would have people fall asleep. There are certain grouping elections that you can have upon the initial purchase and the sale that allows you to have more flexible tax treatments. But every single person is different. And I've seen this really benefits extremely high net worth individuals more than it did single passive investors. So this is on a case by case basis. So I could touch on that. Anybody that wants to talk about it. So this is just a way to talk to your CPA before you invest, guys. Know the tax breaks. Know what your CPA also knows and recommends that you do on investments. Again, understand your participation. Real estate professional, should you go for it? I would. That's just my benefit. Or stick with passive investment and take advantage of all the tax breaks along with income levels that you would get from it. Short-term rentals, build your portfolio with purpose. I mean, everybody needs to offset, like put different things in your portfolio. Real estate, short-term rentals, real estate, residential syndications, stock, crypto, you name it. Put it all in there because one's going to go down every year and one's going to go up. And so far, I've seen real estate go up tremendously.
Yes.
That's the way to go. My bonus appreciation final. You can tell I've still been practicing this over and over and over. I just recently built this, but final thought for now, because every time I do these presentations, I have a different question asked, so I put on additional slides to answer that question, because the idea is never have somebody have a question at the end. But yeah, so final thought. One thing when you do a syndication on this, you never just want to fully put the bonus depreciation number in there and say, hey, here's the number you're going to get on returns. Here's the number you're going to get on bonus depreciation losses. Every property is different based on how it's structured, whether it's the waterfall, land values, cost seg percentage numbers. They're not all cookie cutter. Some of them are higher than others. Some of them are much lower than others. So you never just want to throw a number in there. What you really want to do is break it down on a level that universal for all your investors, something that everybody can attribute, how much percentage they would get back on losses, and then put that side by side with the returns. Because you're essentially telling them completely transparent that I'm going to get you these returns. Absolutely. And these are the losses you're already going to get on this investment. So really, I'm telling you how much in losses you're going to get before you're going to get in returns, which is something people don't really look at too often. And then, if you're serious about using this as a tax strategy, talk to us. There's no such thing as a stupid question. Ask a question if you want to know. Hey, Brian, I've never done this before. Can you just explain it to me? Absolutely. I'll take it from top to bottom. If you want nothing to do with or hear nothing about taxes in any way, shape, or form, I'll explain it to you like I did at career day at my kindergartner school. There's so many different ways that you can explain it or understand it that will benefit you. So other than that, from there, I get to talk about opportunity zones, 1031s. I mean, all the different extra changes, but you tell me if you want me to answer questions or keep on going.
Yeah, I don't see any questions in the chat right now. So maybe just give us a high level on opportunity zones and 1031, because I know you mentioned in the beginning, perfect. That's another tax strategy to avoid those gains on the back end.
Absolutely. And this is something that was in the bill, the one big beautiful bill. They changed the opportunity zone side. So now they've actually created them to be completely permanent. They were like flexible before. Now they're permanent and more flexible on the transfer scale, meaning that every 10 years, new opportunity zones are going to be designated. That was not done before. It was actually a very much longer, bigger time. And especially in Dallas, we were very unhappy in the Dallas area because there were so few opportunity zones because everybody was jumping on ones. So now they're every 10 years are going to be redesignated, re-added. So this is going to be grand for people looking years in the future to build their portfolios. They know that they're going to have something new that's going to pop up that they're going to have as a capital event. They're going to put money into it and walk away scot-free with no tax liability. So what the opportunity zone is going to do, it enhances your basis after 5 years, which means if you sell a property, you put it into an opportunity zone, you would be able to increase the amount of depreciation and losses by 30% if you hold it for at least 5 years. So the one thing about opportunity zones you are going to see the most benefit after 10 years. Here's the rub. Oh, let me go down one. Sorry. Yeah, that was it. Okay. So opportunity zones made permanent. When you go to sell a property, let's say, for instance, you bought a property for 100,000, you sell it for 150,000. All right. In a 1031 exchange, you are essentially kicking the can down the road by not paying anything on the capital gains on the sale or recapture from the depreciation, anything like that. You are taking every penny of that sale and putting it into a new property. That's how you are deferring the taxes on the sale. You're kicking it down the road. All right. Eventually, years and years and years later, if you sell that property and you don't do a 1031, you do have to pay back. But opportunity zones allow you to invest only the capital gain portion, which means if you sold the property for 150K, that 50K gain, all you have to do is invest that gain, that small amount, into a new property. You would be able to keep your initial investment, the 100K, in your pocket, and all of that bypasses the taxable situation. You are essentially putting just your gains, not your capital, your return of capital, just your gains into the opportunity zones. After 5 years, it steps up in basis, giving you more depreciation, more tax loss. After 10 years, it goes away scot-free. You owe no taxes from anything, from the previous sale, from this property, from anything at all. You owe no taxes. It is completely wiped clean. That's the new opportunity zone flexible strategy. And I'm sitting here going, okay, so I just got to think 10 years ahead. No problem. But the big thing is, if you guys know opportunity zones, they're very low economic zones, areas that you have to be including, like renovations, rehab, improvements, or new development. Like all of that has to be done on opportunity zone. You can't just buy a property in an opportunity zone and not touch it. You have to improve on it because it's an opportunity. So, but yeah,
good way to remember that. Yeah.
That's right. Absolutely. And then, of course, going back to 1031 exchange, 1031 has not changed. Surprise, surprise. They talk about it every year that it's going to change, whether it's the timing or the to close, a timing to identify, whatever. It's not going to change, and it hasn't changed yet. But it was mentioned in the One Big Beautiful Bill, because it was trying to explain to people you need to invest in real estate and not worry about the back end, the sale years later. So it was talking about how 1031, you invest 100% of the sale into a new deal that you have to identify in 45 days or a month and a half and close on in 6 months from the sale to your new property.
Right.
The timeline is always the biggest whatever. I don't want to say it on camera, but that never made sense to me, but I get it. By doing this, you are not paying anything at the present time, when you sell the property and going into a new property with a up step in basis, but ultimately it's just a way to defer the taxes, not eliminate them.
Yeah, and for us, Brian, we're asked all the time when we have a new opportunity, can I do a 1031? And it's a little tougher with syndications because
Yes.
you've got, then you become a tenant in common, and on the back end of a transaction, everybody would need to agree to 1031 into the next deal. So that's often harder to do with, a larger number of investors. But
Right.
I would say always ask the question because you never know.
That's right. Always ask. But let me ask you this: do you guys include like tenants in common 1031 exchange capital into purchasing deals?
It depends on the amount because your documents have to be different. There's a different structure, et cetera. So it depends on the amount. We'll consider it, but like I said,
Okay.
just ask.
Absolutely. The only reason I ask that everybody is because you can sell a property and do a 1031 exchange into a syndication. Um, just like Arleen was saying, it is very complicated on the document side, how to structure the agreement to be able to come in, because you have to do what's called a tenants in common or a TIC. But on the tax side, it's very beneficial because you not only get your own percentage ownership, but you also get a completely separate study that nobody else gets. Like not even the GPs, LPs, nobody. You get your own complete study entirely based on the ownership that you have in this syndication. So that does benefit because it will give you more depreciation because it's structured that way.
Right.
So
Great.
that's just one thing. What else we got? So I've done versus a comparison. The good, obviously, if you can tell, I'm more on the opportunity zone side than the 1031 side, which is funny because I also my company, it has a sister company that's a 1031 exchange. So hopefully they don't look at this too long. But I like the opportunity zone over 1031.
Mm-hmm. It's just finding those opportunities in an opportunity zone that can be a challenge sometimes.
Absolutely, absolutely. So I just gave a couple examples: 1031 versus opportunity zones. So if you sell a business, stock, crypto, anything like that, if it's not real estate related, you cannot do a 1031 because 1031 does not apply to the gains from anything other than real estate. But you can roll those gains into an opportunity zone and defer it for 5 years and then eliminate it in 10 years. So
Nice.
that's pretty nice. So you
Yeah.
now have the ability to include business sale to real estate and get the tax breaks.
Very nice. That's good for all the baby boomers selling their businesses, right?
That's right. That's absolutely right. That they don't want to give it to their kids, for sure. But yeah, I gave another example. Say you sell a rental property for $2 million, you got 800,000 in gains. You have in a 1031, you have to reinvest the entire $2 million that you sold it for, not just the gains, but everything, into a new real estate deal within that tight window. The opportunity zone, you sell it for $2 million. You only need to invest the 800,000 of that $2 million that you get into a new deal. The 1.2 million is free and clear, no tax.
Nice.
That is in your pocket because it is essentially a return of capital. Even if you made all that back during ownership, makes no difference. It's at the sale. It's from the beginning when you bought it to the end when you sold it. That's what they're looking at.
Okay, great.
Yeah, and then 1030. See, I talk about this almost as much as I do bonus depreciation, but that's what's in the bill. I wanted everybody to know about the specifics in the new bill. So 1031 still wins if you want to stay in real estate. You want full control of the asset because in opportunity zones, technically you would have multiple partners, multiple investors. If you wanted to just 1031 into your from your own, to your own, all sole proprietorship, that's how you can use a 1031 over an opportunity zone. Preserve depreciation, meaning you can, move your basis from your original property to the new property and give it a little jump start. Or you plan to hold the property until death. Just I was saying earlier, you're just kicking the can down the road until you kick the can. And then opportunity zones, that's if you're getting into real estate, but you're selling your business, get into real estate. This is a perfect opportunity. That's how you put more baskets, more eggs. You want to eliminate tax. You don't just want to kick the can down the road. You don't want to full reinvestment constraints of 1031. You don't want to have to deal with their timelines. You're like, I want to do this on my timeline, darn it. Now you can with opportunity zones. And you're open to a 10-year hold. That is the one downside of opportunity zones. In order to fully take advantage of the tax breaks, you have to stay in it for 10 years. So some places that makes sense because it's just a cash cow, and other places you never know. You might want to exit. You might want to do something. You might want to buy that new 2025 Ferrari that's been sitting out. Who knows? All right, now quick put out there for all the new extras that were in the bill. Now I did it like this. I'm not just going to go over each individual one if it does not relate to real estate. I wanted everything to relate to real estate investing. So I did see that the new work requirements in the SNAP and Medicaid that they put into the bill could actually impact investors, meaning the tenants that are going into a property. With the new bill, it was talking about how Medicaid was going to be sanctioned and the SNAP benefits were going to be lowered. It could potentially delay or give that partial rent payments. You could be looking at a slightly negative amount per month for tenants that were on these programs, because now you're going to have a higher turnover and a little bit higher vacancy rate because they're not going to get as much government assistance as they were getting before this bill. So it's going to increase the reliance on flexible payment plans. So if you guys have a management company that thinks so far outside the box, it's insane. This might be a great way for them to demonstrate that they can do flex payment plans or scales with their tenants to keep a long-term good paying tenant and working with their budget, but also making the rental income that you were expecting on the back end. And then of course the section 179D was repealed entirely, which is going to hurt a lot of companies in the future. So essentially it says that 179D will no longer occur if the construction was complete after June 30th, 2020, after next year. Meaning if you are in the middle of a construction project now that's slated to be in service, let's say September 2026, push it forward, like bring it back. Put it in service before June 2026, because you will not be able to get a 179D, which is, like certain, oh gosh, I'm like blanking right now. 179D deals with the energy tax efficiency, green initiative, LEEDs, that kind of thing. And then of course it also affected section 25C, 25D. This is really for personal residence or single family rental homes, short-term rental homes. They're eliminating the energy efficient home improvement credit, eliminating residential clean energy credit. So it's like saying if you buy solar panels next year and put it on your house for tax breaks, you're not going to get them.
Wow.
I guess we're gonna start relying even more on oil and gas. But essentially with this, I put this in here specifically to show you that if you're looking at getting losses, you're going to the extent of expecting to get energy efficient home improvement credits on your taxes. Don't spend the money on it. Take that capital, combine it, and put it into syndication. With Arleen and Victoria, you guys give the greatest tax benefits. don't try to piece things together with individual improvements or clean energy credits or whatever on your personal residence. Get more losses by investing in multifamily syndication. And
Thank
then
you,
40,
Brian.
yeah. Oh yeah. The nice thing about it is I get to see everything from the beginning and on the back end. And I've worked with you guys for multiple years, so I get to see the actual tax benefits that a lot of investors are having. They're I have some of your investors telling me, "Hey, Brian, I put in like 100K and I got back almost 90,000, like 90% in losses the same year I put it in. Is that normal?" And it's like, yeah, that's it. That's the benefit. So it's good. It's good when your investors are calling happy.
Good.
Yeah.
Yeah.
That makes us happy. Yeah.
And then of course 45L credit is just new energy efficient. So many people ask me about 45L credits. And that goes to commercial real estate as well, getting all those clean energy and losses like that. It is being repealed. So
wow.
as of at the end of next summer or beginning of next summer, I guess, June 30th, we're in Texas, summer last year round here.
Mm-hmm.
But yeah, after June 30th, 2026, no more 45L credits. I mean, it really does. That's how it looks. It almost looks like they just want to eliminate any tax benefit, like increases or tax decreases, whatever, for solar projects, for wind energy. They're just trying to eliminate it. They say people are just doing it to do it. It's not helping. And then, of course, the new SALT cap is more generous. The pass-through entity tax, the strategies to basically lower your federal income level, your tax rates. The tax rates haven't been touched on yet, but I have a feeling that's going to be something more in the future. Tax rates and everything, tax brackets they're gonna change again, like they've done recently. And then of course, real estate tax exemption. If you're, high net worth, $15 million per person, you've got different new classifications on the tax rules, more benefits for your investing portfolio. So really, but that one in a nutshell, invest in real estate. If you're a high net worth investor, you will get extra benefits.
Yes.
That's right. And then my final word, almost perfect. What is it? 12:55. Look at that. Yeah, I mean, the one big beautiful bill, it's not perfect. They put it out there because they could see the trend and everybody was talking about it. Everybody was excited about it. Everybody was just waiting on it. Now it's done, July 4th. So it is in service and it's not going away. It's not changing at least until the end of 2029. Who knows? They might see so much activity, they'll do it again.
Yeah.
Because this is the second go around, guys. They saw the benefits. They saw the market. They saw the Treasury saw some great times. The Fed saw great times. And then once it started going down, they're like, what can we change? This was one of them. Everybody was excited, and here it is. We're here. It's going to maximize your wallets, and it's going to make you super happy you played the real estate game and legally stuck it to the government.
I love it.
Absolutely. And there I am. That is a lot longer beard than I had.
Wow. And I love the little logo. You've got your cowboy hat on there.
Me too. Boots on the
That's
ground.
awesome.
I love it.
And boots on the ground, because I not only do I do webinars, and I do cost seg for everybody. I also do tours. I also do speaking engagements. I love doing this so much because it's also my way of sharing to people how it's benefiting me on my personal investment side.
Yes.
So yeah, it works out.
Wonderful. Well, we sure appreciate you, Brian. It looks like we have one question in the chat.
Sure.
And again, if you can answer it, great. If not, let us know. But the question is, in the case of death during the opportunity zone 10-year period, do heirs inherit the same exact terms and exemptions?
So the heirs, if your will is structured that way and they inherit the property, they get a bump, actually. They get an increase, or what we call a step up in basis. So at the time that you bought it until death, your depreciation as well as of value, they go hand in hand. One depreciation will go down and appreciation will go up. So when you release the property to your heir, they can actually get it market value based on what it's worth the day they inherited it. And that increases their tax basis to whatever point that is, recalculated, and they get a brand new set of depreciation that they can use.
Great. That's
I
awesome.
hope that made sense. I hope that answered it.
It did.
So I'm not saying death is good by any means, but that helps.
Awesome. Awesome. Well, I know, Brian, we thank you so much. We have relied on you for years and years to help us give our investors those tax benefits through the cost segregation studies that Madison has done for us. So thank you so much for that and for your time today, helping us educate our investors on taking advantage of, the benefits of bonus depreciation. I do want to let everyone know that we do have a tax toolkit is one of the resources we offer at reapequity.com. So there's more information there about some of the additional tax changes that occurred, things like the federal tax brackets. There's a little more flexibility there. Standard deduction went up, so that's nice. The other things that we've talked, that Brian has talked about have also will help all of us hopefully save on our taxes. Thank you so much, Brian.
That's what I was just going to say. Always remember, guys, this method does not just apply to multifamily. It applies to literally everything that's income producing real estate. Single family rental all the way up to skyscrapers. It can be used on anything.
And thank you, Brian, for this fantastic presentation. If you guys haven't heard, we do have an investment opportunity, the Austin San Antonio 2-prop. And Brian has given us an estimation of bonus depreciation. So if you want to learn more about that, please reach out to Jack Bolden. He has all that information. So again, Brian, you're a wealth of knowledge. I learned so much every time we talk to you. So thank you so much.
And on your screen, on your screen right now, you've got strategic steps for multifamily investors. That is one of the pages in that multifamily tax toolkit, some tips and tricks for folks to use. So like I said, download it through the QR code or go to our website and you can download it there. Brian has also graciously offered to share his slides. So we will include those with the recording of this huddle when it gets sent out. So thank you, Brian. You're the star.
Yes.
Thank you. Appreciate it.
Say cowboy rides again. So
that's right.
And thanks everyone that joined us today. Please reach out to us at invest@reapequity.com. If you have any other thoughts or questions or just want to get to know what we've got going on. Thanks everyone.
Thank you.
Appreciate it.
Bye-bye.